Hello, this is Joe Novickus, and I'm going to go over a bank reconciliation for you. A bank reconciliation is the process of matching the balances in an entity's accounting records for a cash account to the corresponding information on the bank statement. The goal of this process is to ascertain the differences between the two and to book changes to the accounting records as appropriate. So what we're watching here is we're keeping good control of our cash and our cash balances and understanding how our cash balance is different from what the bank is saying we have. So there are a few things that kind of throw off the balance what the bank says we have and the balance that our books say we have. So here we have is our balance per book. So think of when you write a check. Personally, you write a check in your check register. In business, they go through tons and tons of transactions, and so there are a lot of transactions that are floating around that the bank just hasn't recognized yet. So whenever we go to reconcile here, we're always asking ourselves which party already recorded the transaction, and so the opposite party has to record the transaction. All right, so we're looking at our books and we're looking at what the bank says we have. All right, so for example, interest. The bank gives us interest. So on the bank statement it says, hey, you made $5 in interest. So what we have to do to our books then is we have to add the $5 in interest to make it match. Service charges. Banks charge service charges. They charge service charges for different things. So when a bank has in their statement they charge you a service charge, as long as you agree with the service charge, then you would go to your books and deduct the service charge from your books. You also deduct Nsf checks. Nsf stands for non-sufficient funds. For example, I have a business and one of my customers write me a check. I go and I deposit the check. Let's say the check is for $100. I add the $100 to my book balance. At the end of the month, I get the bank statement, and the bank says that $100 check that I deposited, the customer did not have enough money in their account. Therefore, the check becomes a non-sufficient fund check. So that $100 check had basically nothing in there, so I have to go into my records and deduct the $100 that I already added in. On top of that, usually banks charge an Nsf check fee. So they'll charge you a fee for depositing a bad check. This is why when you go into like stores or businesses, they charge a fee if you give them a bad check. Also, sometimes you might have an accounting error in your books. You might have an addition or subtraction. When you do this reconciliation, you're trying to find those errors. So if something's not matching up, odds are you might have a mathematical error or a recording error somewhere in your books. When you're done with that, you get what is called the adjusted book balance. Then we look at the bank. There are certain things that you do that the bank might not see in time by the time they print the statement. For example, a deposit in transit. Let's say I have 3 customers that give me $300 worth of checks. I deposit on the last day of the month. Checks normally take anywhere from 2 to 3 business days to go through. So if I deposit the checks on the last day of the month and when the day is over, the bank prints out the statement and sends it to me, those checks have not cleared yet. So therefore, the bank has not recognized those deposits yet. So in order to reconcile the balances, to make them equal, I have to add the deposits in transit to the bank balance. I also then, opposite of that, I might write some checks to people and they don't cash them. So when I write a check, I deduct it from my books. The person who I give the check to might not cash the check. So when the bank statement is printed, the bank hasn't recognized that check yet that I wrote because the person hasn't cashed it. Those are called outstanding checks. We want to deduct outstanding checks from the bank balance. Finally, once in a while, banks also make errors. It is important that you deduct or add. You have to interpret the error and then make the change per either the bank balance or the book balance. From there, you will get an adjusted bank balance. At this point, you know you reconciled, or to make equal, when the adjusted book balance equals the adjusted bank balance. Here's an example. Here I have a very simple example of a very simple bank rec. Let's say my book balance at the end of the month was $8,700. The bank balance was $8,939. That tackles A and B. Now I go to C. I made a deposit after the close of banking hours on May 31st. The cycle ended on May 31st, so therefore that deposit was not recognized on the statement. That $856 is recognized in this balance because I added the $856 in. So therefore, a deposit in transit always is added to the balance per bank. Then I wrote some checks, but they have not cleared through the bank. That means the bank hasn't received them yet. The person who I wrote the check to is holding on to. Do you remember what those are called? Those are called outstanding checks. Remember, when I write a check, I subtract it from my records, my book balance. The bank now has not received it, so therefore to adjust the balance, I need to subtract the outstanding checks. Finally, E. There's a charge on the bank statement for serving the account and a charge of $15. The bank already deducted the $15 up in their balance, so therefore I must deduct the $15 from my book balance. When I'm all done doing those and I've gone through and accounted for everything, I should now have an equal adjusted book balance. When those dollar amounts equal in the amount of $8,685, I have reconciled the account. There's a very basic example of bank reconciliation, and now you must practice this on your own.